According to real estate experts, much of the U.S. is entering a delayed correction. The cause? Home prices are still high, and the economy is shifting. For nearly 4 years, people kept saying the same thing: the crash is coming. But the crash never showed up. Instead, the market just kept stretching and stretching and stretching. Now, heading into 2026, the tension finally feels different. Not panicked, not chaotic, just unnervingly fragile, like a window that's been quietly cracking for a long time and only now started to make a sound. So why is 2026 shaping up to be such a pivotal year? It comes down to pressure. 4 kinds of pressure that have been building underneath the surface. First, mortgage rates stayed higher for far longer than anyone expected. Buyers waited for relief, but the relief never arrived. And eventually, a lot of them just stepped out of the market entirely. When buyers disappear, demand thins. And when demand thins, prices don't have much to hold on to. Second, the cost of simply owning a home has blown past what most people budgeted for. Insurance premiums have climbed in dozens of states, especially in the Southeast. Property taxes have followed close behind, rising almost everywhere. Maintenance expenses are higher too. Even homeowners who locked in great mortgage rates are starting to look at the total bill and wonder how long they can keep absorbing these increases. Third, oversupply is forming in places nobody expected to see it so soon. Cities in the Sun Belt and parts of the Midwest spent years building aggressively, assuming demand would stay white-hot forever. But demand didn't stay white-hot. As the market cooled, the construction pipeline didn't. That mismatch, too many homes, not enough buyers, is one of the strongest signals of future price corrections. And fourth, the local economies of several markets are slowing down right as population growth stalls or reverses. Companies are pulling back on hiring. Remote work moves have cooled, and some of the migration waves that reshaped the country in 2020 and 2021 are now fading or flipping the other direction. When fewer people move in and the economic engine loses power, housing markets feel it fast. To build this list, we pulled data from the sources that track the market most closely: Zillow forecasts, Redfin price cut reports, Realtor.com supply levels, new construction filings, insurance trends, and U.S. Census migration data. When you stack those indicators side by side, certain markets stand out immediately. Markets where prices have run far ahead of fundamentals, where supply is climbing, or where buyers have suddenly vanished. Before we jump in, don't forget to hit like and subscribe for more real estate realness. And leave a comment. Are you seeing a real estate slowdown in your city? Okay, let's break it down. Phoenix enters this list at number 10, and honestly, anyone who watched the city's wild ride from 2020 to 2022 probably isn't surprised. This place didn't just boom, it overheated. Phoenix became one of the most aggressive growth markets in the entire country, pulling in investors, builders, remote workers, and anyone fleeing higher-priced states. For a while, it felt like the city was running on rocket fuel. But now we're seeing what happens when the fuel runs out. The first warning sign is oversupply. Phoenix has one of the highest levels of new construction relative to population growth in the country. Builders were working at full speed for years, adding tens of thousands of new homes across the metro. That made sense during the boom, when demand was basically unlimited. But demand isn't unlimited anymore. Zillow and Realtor.com data show listing counts rising year over year, and builders are still delivering units into a market that no longer has a line around the block waiting for them. When supply outruns people, prices lose their footing. Then there's the investor problem. From 2020 to 2022, Phoenix was practically an investor playground. Large-scale investors, mom-and-pop landlords, Airbnb hosts, everyone rushed in. In some zip codes, investors made up more than a third of all purchases. But when interest rates climbed and rent growth cooled, the math stopped working. Many investors have paused purchases, shifted to selling, or started discounting rents just to keep units occupied. When investors pull back in a market they once dominated, the ripple effects are big. Affordability has also collapsed. Phoenix's affordability index is sitting near the worst levels ever recorded in Arizona, and buyers are feeling the squeeze from every direction. Prices went up, rates went up, and now insurance premiums and HOA fees are joining the party. The cost of owning in Phoenix isn't just high, it's unpredictable. And buyers hate unpredictable. By 2026, analysts expect the same pattern to continue. Rising inventory, longer days on market, more price cuts, and more leverage shifting to buyers. Investors are likely to keep exiting or staying on the sidelines, and the construction pipeline is still heavy enough to keep supply pressure elevated. Phoenix isn't falling off a cliff, but for a market that soared this fast, even a moderate landing can feel rough. The city that once couldn't build homes fast enough is now trying to figure out what to do with all the ones already sitting there.
Boise used to be the poster child of the pandemic boom, the place everyone pointed to when they wanted to talk about the great American housing migration. For a moment, it felt like every remote worker on the West Coast was packing a laptop, a golden retriever, and a dream of cheaper square footage and heading straight for the Treasure Valley. Homes that sat for weeks suddenly sold in hours. Bidding wars weren't just common, they were expected. And for a brief, bizarre stretch of time, Boise felt like it had become the new Silicon somewhere. But that frenzy came with the timer, and the clock has officially run out. Post-pandemic, the parade of new arrivals has slowed to a hesitant trickle. The same remote workers who once flooded into Idaho have either settled elsewhere, been called back to the office, or simply realized that uprooting their lives for cheaper housing only makes sense as long as the cheap housing stays cheap. Boise didn't. Prices blasted so far ahead of local incomes that even lifelong residents started looking at listings like they were reading fiction. And the uncomfortable truth hovering over the market now is simple. The fundamentals never caught up. Builders, meanwhile, didn't get the memo. Construction stayed hot even as demand cooled, which means the city is now quietly swimming in new supply, subdivisions built for buyers who have stopped showing up. Inventory isn't exploding, but it's rising just enough to weaken the floor under prices. And in a market where affordability has been stretched past its limits, you don't need a tsunami of supply to trigger a shift. A ripple will do it. The population numbers tell their own story. Boise isn't shrinking, but it's no longer surging either. Growth is flattened, wages haven't kept pace, and that perfect recipe that once made Boise irresistible is now missing half its ingredients. There's nothing wrong with the city, the lifestyle is still incredible, but a housing market can only defy gravity for so long before it loses altitude. Heading into 2026, Boise looks less like a runaway success story and more like a market settling back into reality. Expect softer demand, sellers recalibrating expectations, and a quiet but steady price cooling stretched over several quarters. Nothing dramatic, nothing catastrophic, just the slow release of a bubble that inflated faster than almost anywhere else in the country.
Sacramento was once the great escape hatch for Bay Area buyers. When remote work exploded and people realized they didn't need to live anywhere near the San Francisco office that no one was actually going to, Sacramento became the perfect middle ground. Bigger homes, quieter neighborhoods, cheaper prices, well, cheaper for California, and just enough distance to feel like a reset. For a while, demand poured in so fast it felt like the city had become an extension of the Bay itself. But that wave has crested, and what's happening now is the part nobody wanted to see. Inbound migration has slowed sharply, and in some quarters, it is actually reversed. A big chunk of the pandemic-era movers aren't coming anymore, partly because companies have pulled remote workers back into hybrid schedules, and partly because affordability in Sacramento isn't what it used to be. The whole appeal was cheaper than the Bay. Today, it's more like less expensive, but still painful. One of the biggest contributors to that pain is insurance. Wildfire exposure has pushed premiums dramatically higher across large parts of Northern California. In some neighborhoods, people are seeing double-digit percentage jumps year after year. On top of that, property taxes, already high in California, continue climbing as assessed values adjust to the massive run-up in home prices from 2020 to 2022. Even homeowners who locked in a mortgage they love are staring at monthly bills that just keep inflating. Meanwhile, inventory is climbing. Sacramento's increase in listings is outpacing several nearby metros, which is especially telling in a state where inventory has been tight for years. More homes are hitting the market, Fewer buyers are showing up, and the gap between supply and demand is widening each quarter. That's exactly the setup analysts look for when forecasting downward price pressure. The price-to-income mismatch has also become severe. When median home prices sit at levels that local incomes can't realistically support, the market becomes vulnerable. It doesn't take much: a slight rise in rates, a pullback in buyer sentiment, a few months of slower job growth to push things into correction territory. Heading into 2026, Sacramento is dealing with shrinking demand, rising supply, insurance headaches, tax fatigue, and an affordability ceiling that fewer buyers can break through. Analysts expect more homes sitting on the market longer, more price adjustments, and a buyer pool that keeps thinning. Sacramento isn't collapsing, but the era of effortless demand is over, and the shift is putting real pressure on the market.
Myrtle Beach has always had this strange superpower: the ability to feel fun, affordable, and slightly chaotic all at the same time. For years, that combination pulled in investors, retirees, vacationers, and anyone who wanted to own a slice of the coast without paying Miami or Malibu prices. But beneath the neon lights, the boardwalk energy, and the endless condo towers, something is shifting, and almost no one is talking about it. The biggest storyline? Insurance. The coastal Carolinas are getting hammered with premium jumps, and homeowners are opening renewal letters like they're scratch-off tickets with bad news underneath. Increases of 40, 60, even 80% aren't outliers anymore. They're becoming standard. And in a place built on the promise of low-cost beachfront living, that's a tectonic change. Suddenly, that cheap condo with an ocean view comes with carrying costs that climb every single year, and buyers are starting to balk. Then you add the investor layer. Myrtle Beach became a playground for condo investors and short-term rental owners who saw a cash flow machine and jumped in with both feet. At one point, it felt like every other unit was being photographed with wide-angle lenses and listed on vacation rental sites. That works beautifully when demand is endless. It works less beautifully when thousands of new STR-friendly units keep getting built at the same time visitor numbers flatten and insurance eats your margins from the inside out. And yes, they've been building. A lot. New subdivisions, new vacation rentals, new condo towers rising like they're being 3D printed and fast forward. The skyline keeps growing, but the local wages haven't caught up in the slightest. Service workers, the people who keep the entire local economy running, can barely touch the new inventory being added. And when local incomes disconnect from local prices, the market has to rely on outside demand to stay inflated. The problem is that demand is getting softer. This leaves Myrtle Beach in an awkward position heading into 2026. Too much supply, too many investors with rising expenses, too many coastal units that become financially fragile the moment insurance renewals spike again. The lifestyle isn't going anywhere, the beach is still the beach, but the real estate math is shifting fast. Expect an oversupply hangover, investors quietly offloading units, and price cuts concentrated in the coastal zones where costs are rising the fastest. This is the kind of correction that won't make national headlines, but will absolutely show up in listings, price charts, and investor group chats.
Nashville's rise over the past decade felt unstoppable. Music, money, migration, repeat. Every year brought another wave of newcomers, another crane in the sky, another headline about how the city had arrived. But in real estate, momentum has a shelf life, and Nashville just hit the part of the cycle where the shine gives way to numbers, and the numbers are starting to look a little uneasy. The construction pipeline is the first warning sign. Between 2024 and 2026, thousands of new apartments, many of them high-end, amenity-stacked buildings, are finishing at the same time. Developers assumed the migration boom would continue indefinitely, the way a band assumes the crowd will keep cheering through the encore. But the audience is thinned. Population growth has slowed sharply compared to the frenzy of 2020-2022, and the demand those buildings were counting on isn't showing up with the same enthusiasm. You can already see it in the rental market. Luxury units, which once had wait lists and call for availability banners, are quietly offering concessions. Free months, gift cards,
discounts that were unthinkable even 2 years ago. And after multiple quarters of rent declines at the top end, the leverage is shifting. Renters aren't competing anymore. They're comparing. And when the high end softens first, the pressure trickles downward through the entire market. The investor story adds another layer. Nashville became an investor favorite, especially in neighborhoods where short-term rentals look like an easy win. That era is changing. STR regulations have been tightening, and the city's crackdown on uncontrolled Airbnbs means a growing number of hosts have to pivot, sell, or convert their units to long-term rentals, which only adds even more supply to an already crowded field. Investors who counted on cash flow now have to run the math twice, and some are quietly backing away from new purchases. Meanwhile, home prices outran local incomes for 5 straight years. That imbalance only works when growth is explosive. When growth cools, the imbalance becomes a drag on both demand and affordability. Buyers hesitate. Sellers get stuck between expectations and reality, and the market begins to feel heavy in a way that wasn't imaginable during the boom. Heading into 2026, Nashville is staring at a classic oversupply moment. Too many new units, too few new residents, and too many investors trying to adjust to a different rulebook. The multifamily surplus is already influencing rents, and the next phase is a broader softening in the for-sale market. A correction isn't dramatic or chaotic. It's simply the market exhaling after years of sprinting.
Salt Lake City was once the quiet success story of the Mountain West. During the pandemic, it became a magnet for people seeking space, jobs, and a more affordable alternative to the coasts. Home prices skyrocketed almost overnight, and for a while the market felt unstoppable. But as we head into 2026, the cracks are showing, and they're hard to ignore. Affordability is the first problem. Price-to-income ratios in Salt Lake City are now among the worst in the country. Even with relatively high wages, local buyers are feeling stretched, and entry-level homes are moving out of reach for many families. When affordability breaks down, the market loses its most dependable demand, the first-time buyers who keep neighborhoods active and transactions flowing. Population growth, which fueled so much of the last few years, is slowing. The flood of new residents that once seemed endless is tapering off, and net migration has flattened. Fewer new arrivals means fewer eager buyers to compete for limited homes. When demand softens, even a small uptick in supply can tip the balance toward price pressure. And supply is rising. Active listings are up, and multifamily construction continues at a rapid pace. Developers are finishing apartments and condos in the hopes of meeting demand that isn't as strong as they expected. Meanwhile, rents are softening in several segments, signaling that even the rental market, traditionally more resilient, is feeling the weight of excess inventory. Wage growth hasn't kept pace with these higher housing costs, leaving even employed locals struggling to compete in a market that once seemed manageable. When incomes stagnate while prices climb, it's the perfect setup for a slowdown. Looking ahead to 2026, analysts see the potential for prices to decline anywhere from 5 to 10%, depending on mortgage rates, local hiring, and continued migration patterns. It's not a crash scenario, but for a market that shot up so quickly, a soft landing could still feel significant for homeowners and investors alike. Salt Lake City's boom years may have paused, and buyers and sellers are now learning how to navigate a market that has suddenly become more measured, more cautious, and a lot less predictable.
Las Vegas has always had a flair for drama, and the housing market is no exception. Prices can soar in months, then slide just as quickly. And after the pandemic boom, the city is feeling some of that volatility again, but this time with a few new complications. The first challenge is income. Vegas relies heavily on tourism, hospitality, and service jobs, which are notoriously cyclical. When the Strip hits a slow season, or when consumer spending dips, households feel the pinch immediately. That income volatility makes buyers cautious. especially when home prices have already raced far ahead of what local wages can support. Investors and iBuyers were once major players in Vegas, scooping up homes for flipping or short-term rental profits. But as mortgage rates rose and price growth cooled, many exited the market simultaneously. The sudden pullback left a gap in demand that local buyers alone cannot fill, amplifying the sense of instability. Redfin data shows that Las Vegas now has one of the highest shares of price cuts in the U.S., reflecting a market where sellers are competing harder for fewer committed buyers. Meanwhile, new construction hasn't slowed. Suburban expansions and apartment developments keep supply climbing, which is exactly what you don't want when buyer confidence is shaky. Adding to the mix, climate concerns are creeping into buyer psychology. Water scarcity in the desert, combined with increasingly intense summer heat, is starting to make even long-term residents think twice. The city's rapid growth during the pandemic suddenly feels more like a liability than a luxury, and some buyers are factoring in the cost and risk of scarcity when making decisions. Heading into 2026, the outlook is cautionary. Las Vegas isn't facing a crash, but analysts place it in a medium to high risk category for correction. Prices may adjust downward in certain neighborhoods, days on market will lengthen, and sellers will need to get creative to attract buyers. Vegas has always bounced back, but this cycle feels more measured. The city may still dazzle with its lights and entertainment, but the real estate market is reminding everyone that volatility has a price, and that price is starting to show up in listings, contracts, and the bank accounts of new homeowners.
Fort Myers and Cape Coral have been on a wild ride for years, and right now it's looking more precarious than most buyers realize. During the pandemic, Florida's Gulf Coast exploded with demand. People wanted sun, space, and the perception of safety from storms that had rattled other parts of the state. Prices soared, investors moved in, and builders raced to keep up. But today, the market is straining under a combination of insurance shocks, oversupply, and lingering hurricane risk. Insurance is the first headline you can't ignore. Homeowners in Fort Myers and Cape Coral are seeing premiums jump anywhere from 50 to 100%, particularly in neighborhoods hit hardest by recent hurricanes. Suddenly, what once looked like a manageable monthly bill is now a substantial financial burden. For many, the math just doesn't add up anymore, and that's forcing some owners to put their properties on the market faster than they anticipated. Construction hasn't slowed. Builders continue to deliver new homes and subdivisions at a rapid pace, even as demand softens. That influx of inventory comes at the worst possible time. While higher insurance costs are discouraging buyers, new units are flooding the market, creating competition among sellers and softening prices. Investor-heavy neighborhoods are particularly vulnerable. Many of these buyers were counting on rental cash flow or quick flips, but rising insurance costs and slowing appreciation are squeezing returns. Some investors are starting to exit, selling at current market values that are still well above pre-hurricane levels, but potentially below what they paid at the peak. The result is an oversupply problem combined with uncertainty, which is exactly what markets don't need when buyer confidence wavers. Home values remain historically high, but affordability is eroding, especially for local residents and long-term buyers who aren't investors. When combined with the persistent hurricane risk and rising costs, these factors create a fragile environment for 2026. Buyers are increasingly cautious, sellers face longer market times, and the usual seasonal demand spikes may not be enough to stabilize prices. Heading into 2026, Fort Myers and Cape Coral are facing clear downward pressure, especially in flood-prone zones. It isn't a crash yet, but the market is telling a story. Rising costs, rising supply, and climate risks are colliding, creating conditions where even a small shock could ripple through the local real estate landscape.
Raleigh-Durham used to feel unstoppable. In 2021, it was one of the hottest real estate markets in the country, attracting tech workers, remote employees, and anyone looking for more space without leaving the East Coast. Prices surged, bidding wars flared, and developers raced to keep up with the seemingly endless demand. But the heat is fading, and the market is starting to feel the weight of its own growth. One of the biggest pressures comes from tech hiring. Raleigh-Durham's boom was fueled by high-income jobs, especially in tech and biotech. When companies pause or slow hiring, the pool of buyers with purchasing power shrinks immediately. Without those buyers, even the most attractive listings start to sit longer, and price momentum begins to stall. Supply is rising fast. The Metro has one of the most aggressive multifamily construction pipelines in the country. Apartment complexes, condos, and new subdivisions are completing at record-breaking rates, just as demand softens. That combination is already creating stress in the market. Landlords are offering rent concessions to fill vacancies, signaling that even strong demand segments are beginning to weaken. The problem isn't just a temporary slowdown. It's structural. Migration trends that fueled the post-pandemic surge are reversing slightly. Fewer people are moving in from high-cost states, and some of the newcomers from the last few years are rethinking their plans. When supply grows while demand shrinks, the result is a textbook setup for price flattening, or worse, a decline. Analysts are paying attention. Multiple forecasts rank Raleigh-Durham among the top 10 metros at risk for correction in 2026. It isn't about doom and gloom, it's about recalibration. Buyers who jumped in at the peak may find themselves holding properties longer than expected, and new entrants will need to navigate a market that's suddenly less forgiving. Heading into 2026, the outlook is cautious. Prices may flatten for multiple years, rents could soften further, and sellers will need to be realistic about expectations. Raleigh-Durham isn't crashing, but the city that once felt like a rocket is now coasting. And in real estate, coasting sometimes precedes a bumpy landing.
Cape Coral and Naples are facing a storm of challenges that makes this region the most vulnerable major market heading into 2026. For years, buyers flocked here for sunshine, waterfront living, and the promise of appreciating property values. Prices skyrocketed during the pandemic, with many homes now sitting 40 to 60% above pre-pandemic levels. That kind of growth is exciting until the costs of ownership start to outpace reality. And in this region, reality is arriving fast. The insurance crisis in Florida hits Cape Coral and Naples harder than almost anywhere else. Premiums are rising by thousands of dollars per year, especially for homes in flood zones or areas prone to hurricanes. Many homeowners are now paying more for insurance than for their mortgage, a scenario that would have seemed absurd just a few years ago. Naturally, buyers are pulling back, and some are outright leaving the market. Construction continues unabated. Developers are building new homes, condos, and subdivisions at a pace that ignores the cooling demand. The result is oversupply in a market where the pool of qualified buyers is shrinking. The combination of rising inventory and declining buyer confidence is a perfect recipe for price softening. Climate risk is another silent pressure. Coastal zones are experiencing population declines as the threat of hurricanes, flooding, and sea level rise becomes impossible to ignore. Even long-term residents are recalculating their risk, and some are relocating inland. When people vote with their feet, it sends a clear signal to the market. Affordability has completely broken down. With prices so far above pre-pandemic levels, rising insurance and taxes compounding the burden, even well-paid buyers are starting to hesitate. The market that once seemed unstoppable now faces multiple headwinds, pushing in the same direction: higher costs, more supply, and climate uncertainty. Heading into 2026, Cape Coral and Naples represent one of the strongest correction risks nationwide.
This isn't about a mild slowdown. The region is under pressure from every angle, and buyers, sellers, and investors alike are being forced to navigate a market that has gone from overheated to fragile almost overnight. The conditions here are a cautionary tale for the rest of Florida, and for anyone who assumed that coastal growth could continue without limits.
Across the markets we've covered, a few themes keep repeating. Oversupply is rising in multiple metros, insurance and taxes are hitting homeowners hard, migration trends are slowing, local economies are cooling, and investors are starting to pull back. These aren't signs of an imminent crash, but they are warning lights flashing red for anyone buying, selling, or investing in 2026. Pay attention, plan carefully, and approach these markets with caution. Don't forget to like, subscribe, and comment to see more updates like this one. And thanks for watching.